Welcome to today's Explainer. We're diving straight into a high-stakes forensic mystery that could directly impact your wealth. And guess what? HMRC is the lead investigator. Today, we're talking about the offshore bank accounts held by non-resident Indians living in the UK. With some really sweeping changes coming to the UK tax code, simply looking at your bank balance is literally no longer enough. You're about to become a financial detective for your own money.
So let me start by asking you a fundamental question. Think your Indian bank account is just one pot of money? Many Indians living in the UK keep years, sometimes decades, of savings in a single Indian bank account. It looks like just a single number on a screen. But HMRC may see something very different.
Okay, let's dive into this, because here's the problem. That one account may actually contain original capital, rental income, bank interest, investment gains, and old salary savings. For UK tax purposes, these amounts may have vastly different tax treatments depending on the applicable rules. This becomes especially important for eligible former non-DOMs reviewing historic funds or considering the temporary repatriation facility. If you can't identify exactly what's inside the account, analyzing a transfer can become much more complicated.
Which brings us to part one, breaking down this one-pot illusion.
What looks like a really simple savings account in India is actually a complex archaeological dig of funds. A perfect example of this is the non-resident external, or NRE, account. India's view is super simple. They want to encourage investment, so interest earned in an NRE account is tax-free. But the UK's view? Well, if you're a UK resident, you're taxed on your worldwide income on an arising basis. So that tax-free interest in India can actually trigger a massive 40% liability in the UK for a higher rate taxpayer. And since there's no Indian tax paid, there's nothing to claim relief against. It's a pretty shocking paradox. Now, what's really interesting about this is a hidden lifeline buried in the UK-India Double Taxation Avoidance Agreement. It's known as tax-sparing relief. This provision basically recognizes the tax India voluntarily gave up to incentivize your investment. It grants a UK resident a 15% notional tax credit for that tax-free NRE or FCNR interest. That's foreign currency non-resident, by the way. This brilliantly protects the benefit of the Indian tax incentive. However, and this is a big however, it's strictly valid for only 10 years from the date the account was opened. After that, the full UK tax rate applies. All right, let's move to Section 2, the impending end of the non-DOM rules.
The rules we've relied on for years are literally being torn up, which makes a forensic understanding of your offshore money absolutely crucial. There's a very real ticking clock here. In the spring 2024 budget, it was confirmed that the current remittance basis for non-DOMs is being completely abolished on the 5th of April 2025. This means non-DOMs who continue to be tax resident will be taxed on their worldwide income and gains as they arise. To ease the transition, they're introducing the Foreign Income and Gains, or FIG regime, along with a temporary window with reduced tax rates of 12% and 15% to bring your money to the UK. For new arrivals, this replacement FIG regime actually offers 100% relief on foreign income and gains. But it only applies to your first 4 years of UK residence, and it strictly requires 10 consecutive years of non-residence beforehand. As you can imagine, this drastically accelerates the tax timeline for anyone currently living in the UK under the old rules.
Let's move on to Section 3, decoding mixed funds. Remember that one pot of money we were just talking about? Well, in HMRC terminology, that's called a mixed fund, and honestly, it's a massive headache waiting to happen. It's basically an account containing a blend of different types of income and capital, or funds accumulated across multiple tax years while you are claiming the remittance basis. If an eligible former non-DOM cannot clearly identify what is inside this mixed fund, analyzing any transfer becomes immensely complicated. And this brilliantly illustrates exactly why you have to visually and legally segregate your funds. When money is transferred from a mixed fund, HMRC applies incredibly complex ordering rules to identify what you're remitting. Without meticulously tracing and segregating clean capital from foreign income and gains across specific tax years, you risk getting taxed at the highest possible rates when you move that money. The solution here? Keep records. Understand the exact composition of your accounts. You have to review historic transactions before moving a single rupee. Because sometimes the biggest tax issue isn't the transfer itself, it's the history behind the money. Lacking a forensic history means HMRC is going to apply those punishing mixed fund ordering rules, maximizing your tax bill.
Which brings us to Section 4, the TRF opportunity.
So the crucial point is this temporary repatriation facility, or TRF.
This facility allows former remittance basis users to designate historic foreign income and gains that arose before April 2025 and remit them to the UK at a significantly reduced rate. For the 25-26 and 26-27 tax years, that rate is just 12%. Guys, this is your one-off chance to finally cleanse your historic offshore wealth before standard rates kick in. But you absolutely have to follow a strict forensic process. Step 1, audit your mixed funds to identify the taxable elements. Step 2, designate those eligible amounts for the TRF. Step 3, and pay attention, this is vital, transfer the designated amounts into a newly opened segregated TRF ring-fenced account. And finally, step 4, only then do you repatriate the funds to the UK. Segregating your funds like this provides the clear audit trail that HMRC expects. And please, don't forget the Indian side of the equation. Even if you sort out all the UK rules, Indian banks will flat out block the transfer if you fail their compliance. For an NRO account, repatriation is capped at $1 million per financial year. You've got to follow limits set by FEMA and the Reserve Bank of India. You must file a Form 15CA online and obtain a Form 15CB certified by a chartered accountant, proving Indian taxes were paid. The absolute #1 reason Indian banks reject transfers is a mismatch between these forms and your Form 26AS tax statement, specifically regarding the tax deducted at source. This leads to our final section, why your money's history matters. Let's move on and see how this builds because the stakes here are incredibly high. The UK and India actively share financial data under the Common Reporting Standard. If HMRC receives data about an undisclosed Indian account, they'll send you what's called a nudge letter. And let me tell you, HMRC has an incredibly long memory. If you fail to correct undisclosed offshore income, maybe because you just mistakenly thought an NRE account was tax-free in the UK, you could face massive penalties of 150% or more under the requirement to correct regime. No way do you want to be caught in that.
I want to leave you with this defining thought today. Your bank balance tells you how much you have. Your records tell you what it really is. As an eligible former non-dom reviewing historic funds or looking at the TRF, your records are literally your only shield. It is absolutely essential to trace, segregate, and document every single deposit before you initiate a cross-border transfer.
So I ask you, if HMRC audited your Indian accounts tomorrow, could you prove exactly what's inside them? Don't wait for a nudge letter to find out. Take the time right now to understand the composition of your accounts, utilize the TRF window if it suits you, and definitely seek professional tax advice to protect your hard-earned wealth. Thank you for joining me on this explainer, and happy auditing.